mid-cap bank. It has posted a very strong Q3 earnings, and yes, it's one of the top gainers today also. Net NPA, it's lowest in 11 quarters. That's a significant, up move coming in when it comes to the asset quality. Also, the third hint for this bank is the stock is up 66% already in the last 1 year as well. So, these are the three hints. You must be guessing about the company, and yes, a little bit of suspense, but the company in focus, which should be featured in KYC, is DCB Bank. That's the company which I'm talking about. We will understand much more about it, but the concern remains is, why are we calling this bank? It's a small cap bank. Q3 numbers are good, but let's get into the details. A lot of important questions for it, especially when a mixed set of numbers are coming across the banking peers, especially in the mid cap, small cap also. What led to this strong Q3 performance, and will this go ahead also in Q4 also? That's something, the first question we'll ask about. The second question is the NIMs, the net interest margin, that has done well in Q3, but will it be also strong in Q4? That's something which the management will answer to us. The deposit repricing timelines. Is it the fourth quarter of FY26, first quarter, or the second quarter of FY27? That's what we'll be looking out for. Apart from this, also, we'll be asking about the important targets for RoA or RoE, return on assets, return on equity. What are the important targets the bank is setting? What has led to this capital adequacy ratio declining below the 16% mark? Is this just an accounting adjustment, or some question is there on the balance sheet? That's what we'll be asking. And of course, the views on the slippages and the ECL impact for the bank. Now, ECL is a kind of a provisioning measure which has been taken to put it in a simplified manner. And also, you can look at this, and remember, whenever I'm talking about banks, if it gets too complex, we will give you some abbreviations, and I will try to simplify it for you for the analysis. Also, apart from this, we'll be joined on the show by Praveen Kutty. He's the MD and CEO of DCB Bank. But let's understand a little bit more about the bank. And yes, you must be wondering, Q3 numbers, I will give you all the updates, the 9-month updates, the Q3 updates, everything will come in KYC. But about the company, it's a mid-cap bank, and the total business has crossed 1.24 lakh crore rupees. So that's a big amount. It has 469 branches, still very smaller compared to the bigger players. But nevertheless, it's a start. It's a national bank catering to the self-employed segment. That's what the bank claims. And we'll, of course, ask about who are the overall usage for this bank, and this is promoted by Aga Khan Fund for Economic Development, AKFED. Also, Platinum Industries also has almost combined basis 16.24% stake. Apart from this, the mortgages, MSME, educational loans, agri and gold loans, that is where they're having a diversified book when it comes to DCB Bank. Apart from this, the Q3 numbers, that's what everybody is talking about. Strong demand coming in self-employed and SME segments as well. That's one of the key reasons the Q3 numbers went very strong, but the operational numbers were very strong as well. The slippage ratio was of 3.08%. That's the lowest in the last 18 quarters. But you must be wondering, what's the asset quality like? And it is very strong. The NPA is lowest in 18 quarters. And if you talk about the net NPA, that is also lowest in 11 quarters. So see, the asset quality is good, slippages also is decent, and largely most of the operational parameters when you track a bank, that's also very strong. The credit cost, that stood at 0.37%. That's lower a bit than what the threshold was made by the management, and that's what I'm talking about. That was earlier at 0.45%. Apart from this Q3 performances, the 9-month growth numbers are very strong. The retail mortgages, that's up 21% on a year-on-year basis. A small base business, but the co-lending, that's where the management has been very bullish. It's up 117% on a year-on-year basis. The construction finance on a 9-month basis, it's up 38% on a year-on-year basis. Also, the return on equity targets, these are very much important when you are judging a company in KYC. The FY26-27 is around 13.5%. And if you go 1 year ahead, that comes to around 14.5%. These are the targets which are being set by the DCB Bank. And that's earlier it was there. But remember, just to give you a revision, what these ratios actually mean. GNP means gross net performing assets. That's where you check the asset quality. NII, that's something like a revenue for banks, but it's, compared of both the interests, net interest income. That is where we start judging a company in a banking space. Also, the third important is the return on equity, return on assets. That's where you see the return ratios coming in for the banks. Healthy ratios is generally near 1 for the return on assets. CASA is also very much important. You should know current account, savings account. That is where we look at, how the trends are going. Are the deposits going up? Is the money going to mutual funds? So this is the definitions which you should revise before we start the KYC show. But that is what you need to know when you are doing a banking company in KYC. But there are some parameters also in KYC show, and I have tweaked it since it's a banking company and 8 of them are there. But largely we look at the income statement, but more importantly, operational parameters and return ratios are much more important for a bank rather than just the income statement. The street cred, what stock return has come in, be it 1 year, 6 month or 5 year basis. Analyst take I have taken interestingly this time instead of valuations and the outlook going ahead. Based on these 8 parameters, we will be giving the KYC ratings for the bank. The first one is, of course, the income statement. Let's talk about it, and largely I'll give you the FY24-25 numbers, the NI and PAT. This is something to look at. Operational profit also, that has also seen a good increase coming in. There are some benefits coming in, but overall the business has improved, and once the business improves, most of your parameters also improve. Remember, there are a lot of provisioning impacts as well which impact the PAT numbers, but it has seen a decent number. But the real cake, or you could say the real cherry on cake, is the strong Q3 numbers. That is what Street is liking. The net interest income is up 15% on a year-on-year basis. And if you look at the other numbers also, the PAT numbers, the provisions, they have also done a decent one. The provisions are just up 10% at around 74 odd crore rupees. The net profit, it's up 22%. And remember, there are labor code impact also does come in. But despite that, a really strong numbers coming in, and the winner is of course the gross GNPA. That's at 2.72%, and that is something you could look at, of almost 11 quarter low, and net NPA also such a strong asset quality change which has come in. It's on the positive side. Also, let's look at how the margins actually pay out as well, and that is where we see a good strength also coming in. The second one is definitely going to be the balance sheet. Let's go and talk about the balance sheet or what happens here. And here itself, you see, it is well capitalized. That's what I'm talking about. The deposits and advances, these are the lower numbers to look at. They are there in the balance sheet and they are growing. It's a business model for them. So deposits and advances are also showing a good growth. Now, there is an estimation. There hasn't been 3 months completion, but from Nirmal Bang, we have taken the estimation, and this 24 and 25 are from the company numbers. So net, it's a neutral thing, and it's a well-capitalized bank. And we'll, of course, look at the capital adequacy ratios also, because that number fell below the 16% mark. Of course, there might be some banking jugglery involved in that, maybe a year-end settlement, but definitely a concern for me. But there are some operational ratios we should be looking at, and I have tried to compile as simple as possible for our audience at KYC. And that is where you say it's largely stable when it comes to the cost to income ratio, and it's on the lower side. It's still better for a bank. Let's move on and show the deposits. That has also increased a lot, and interesting, from around 60,000 crore, it's jumped up to 67,750 crore. Remember, these are 9-month numbers. Apart from deposits, let's talk about NNPAs, and that has been declining gradually, 1.22, 1.21, and now it's at 1.1%. So definitely we can see that the overall operational parameters, they have improved a lot and have given a very, very strong thumbs up when it comes to DCB Bank. Apart from this, let's talk about the return ratios. What are much important? The return on assets, that has actually kind of come down. It's around 0.89%. I think the numbers are jumbled up, it seems. And yeah, the return on equity, this is the real number to look at. That previous numbers, there was some error, but you should look at this number, return on equities. That has gone up and it's decent at 12.5%. So net, the return ratios, they seem good. Net interest margin, they seem to bottom out as well, and that's what we'll be asking Praveen as well. But overall, the return ratios are strong, so I'll give a strong thumbs up. So we have done with a lot of numbers, we are done with a lot of jargons. Let's simplify it also, our analysis, and let's go on to something called shareholding. Largely the promoter holding is not significant, it's around 15 to 16%, and they have slightly increased it, that's around 16 odd percent. But one thing which I liked about this counter is the FIs and DIs. The institutional participation was there. There was a dip for both of them, but then again that interest came back, going up to 12%. And for even the DIs, the participation was more than 30%. A little bit of stake in the public that has come down. So, but overall, the participation has been really strong for the institutions, and because of that, I will be giving this a neutral rating. Apart from shareholding pattern, let's talk about the street cred, what has happened. Last 1 month stock is up 14%, a very good positive technical momentum if you're a short-term investor or a trader in this counter. 6 months stock has given 40% return, and if you look at the other numbers also, over the last year-to-date basis, it's up 13%, last 1 year it's up 66%. But if you're a really long-term shareholder, for the past 5 years, it's just 70%. So for that basis, I'll be just giving this a neutral rating when it comes to the street cred. But apart from that, let's talk about what the analyst community is talking about this stock. And interesting, there are 22 analysts having a view on this stock. I thought this would be a number would be less, but there is a lot of, you could say, interest on it. The 12-month return potential, that's around, you could say, 12 to 13% of growth coming in, and 100% of all the analysts are having a buy rating. That's very much interesting. That means they are still bullish on DCB Bank after results. The target price being set is at around 220 rupees per share. That's what I was talking about, around 12 to 13% potential. But yes, the stock has run up and the number is strong. So net, I have given the analyst stake a very strong positive thumbs up. The last one is the outlook. Now the company aims to double the balance sheet size every 3 to 4 years. This has been already stated earlier. So after the earnings in the con call, there hasn't been any upgrade of any guidance as such. So it's like a repeat, and that is where I've given a neutral rating for it. The target GNPA, they're coming up that 2.5%, and the net NPA of 1%. They're likely to touch that portion as well, the way they are going. And the loan growth guidance, they have kept it unchanged, 18 to 20% on a year-on-year basis. So this is the overall outlook for DCB Bank, which you would be focusing on. ROE numbers also, just give you a revision, that's around 13.5% and 14% for the next 2 years. But net, it is a neutral rating when it comes to the outlook. So we discussed a lot of parameters for a banking stock like DCB Bank, and a lot of analyst coverage is there. But let's just give you the entire picture of entire KYC ratings which we have given, and it's largely a very strong set, to be honest, in recent times, which I've covered on my show. The income statement, a strong growth coming in. It's a strong positive balance sheet. It's decently capitalized. Operational parameters and return ratios, all of them have done well. It was very difficult to find out where the pain is. Shareholding and street cred, it's largely neutral, nothing much great about it. But yes, of course, the institutional participation did increase. On the other hand, analyst community is very bullish, and outlook, it's been same. Nothing has changed incrementally post Q3, and because of that, I have given this as, you could say, a neutral rating. But total overall, I have given DCB Bank 6 out of 8, and that's really, you could say, one of the highest ratings in KYC. Generally, we give in that band. So this is what, is the total picture for RCB Bank. And now the street cred is that Praveen Kutty, the MD and CEO of the bank, he will be joining us. He's been associated with the bank for the last 9 years. He has held leadership positions also, and that also this includes Development Credit Bank and Citibank as well. But on to Praveen Kutty. He's the MD and CEO of DCB Bank, and he's going to discuss with us the important questions. And the first one is definitely going to be on the Q3 performance, how the performance has been there. Hi.
Thank you, Sharat, for having me here. It's been a good quarter. I say it's good on account of 2 reasons. One is a consistency. We've grown our liabilities by 19.5%, assets by 18.5%. positive CD ratio, and this has been happening, quarter on quarter for the last 6 to 7 quarters. So we're very happy with the consistency of the growth that we see. The second part of the consistency is in terms of the parameters. In this quarter, every parameter, whether it be NIM, whether it be fee, whether it be cost, or whether it be provisions, we've done fairly well. So in both ways, we're happy with the kind of performance that we have like across all the lines. The second part is the resilience. We took a 26 crore plus hit on account of the new labor code, and that is despite that we have shown a reasonably good set of numbers, highest ever quarterly profit. And it's always good to say despite a headwind rather than say because of headwind. So that way we are happy with the kind of performance that's come through. It's basically the result of a series of actions that we've taken, and it's the quality of the strategy that we have. We've gone granular, we've gone secured, and you're seeing the benefit of that coming in the longer term.
Praveen, this has been a very stark outperformance if you compare that with your peers, and there is something definitely which the bank is doing which is actually outperforming in the mid-cap space. That's where I analyze the stocks for our audience at KYC. But the second question is on the net interest margins. They have done well. It's of course better than what the street was estimating, and you also mentioned that. But what's the guidance ahead? Because most of our discussion is going to be on the future outlook. So the NIMs, what's the kind of guidance we can expect now?
I think the worst is over. The nadir was Q2. Q3 is improved. I know the full impact of the 25 basis point repo cut has not been built in yet. But despite that, I see a vibrancy in terms of the deposit growth, the granularity of deposit, and also the reduction of cost of deposit. So if you look at the past, and past is an indicator of the future, you see that we managed to bring down our top 20 ratio to 6.61%. We managed to bring down the cost of deposit by 10 bips to 6.86%. And we still have grown by 19.5% YOY. So it's a question of getting the team aligned. It's not easy. It's easy for me to say here, but getting the team aligned. And that's what a lot of work that the management level has gone into, getting 11,000 people to kind of think in the same way and get them to act in a particular fashion. I always felt that we left a bit on the table in the earlier days. Price was a reason for sale, but now that whole ethos is changing. You don't come to us just because of rate, but you come to us because of technology, of seamlessness, of usage, and of course because of relationship. It's a journey which has just started. I don't think we have even reached anywhere there. But it's a good start.
Right. But coming back, Praveen, the deposit repricing time, most of the banks which I spoke with, they have given the first quarter, or you could say the fourth quarter or the first quarter of FY27. Your deposit repricing, the entire adjustment, will it go till the second quarter, it seems?
It should, because we always go for longer deposit, because not almost, 50% of our book is mortgages, which are long tenor loans. So obviously we don't want to have a tenor gap. So we go for higher tenor deposits. It's good in terms of in a falling market because you get the benefit of it over a longer period of time.
Right.
And we suffered when the rates went up, but that's the cost of doing business. That's the kind of market that we are in. So long duration deposits are what the bank is going for. And when there's a drop in rates, you tend to get the benefit over a slightly longer period of time.
Well, yes, and of course the RBI MPC meet is also coming up in February. We'll be watching out before that as well. But just to give the perspective to our viewers, your different you could say the categories the bank is servicing. Amongst the categories of loans which are being given out or the business segments, which of them are showing a really strong double-digit growth, or you could say outperforming the other segments, or is it that all the cylinders are firing at once?
No, not really. I mean, all cylinders don't always fire at the same time. I wish it did, but it doesn't. So the fact that we were in a secured segment is helping us. The fact that we are in the ticket size that we operate is typically around 27 lakh to 30 lakh. that has weathered the headwind, and we see increasing demand coming in there. We made some small tweaks about a year and a half back. Earlier, our home loan to business loan ratio was 1:1. Now it is skewed more in favor of business loans as compared to home loans, and that has helped the cause on multiple revenue lines. We see a good momentum in our construction finance book. Again, it's a small ticket construction finance that we do. Our agri portfolio is doing reasonably well. I think the rural demand, the rural infrastructure going up, plus the good monsoons have resulted in increased agri loans over the year. And lastly, I think we are also seeing the benefit of the GST and PLI, the structural reforms. We're a small bank, but we're seeing the percolation of that coming down to us as well in terms of repayment and also in terms of asset growth.
Interesting. Praveen, what about the views on slippages and the ECL impact? ECL, for our viewers, just to explain, it's the expected credit loss framework for provisioning. That's like an overhang on banks, but of course it applies to every bank. But any kind of views coming in for this ECL impact and any slippages?
Our slippages in the bank has been coming down. We are at 3.06% right now, which is a 3-year low, but it's still on the higher side. I believe our slippages should be somewhere around 2.5%. So we would, and I think it's a congenial environment. It is benign environment. So that journey continues. As far as ECL is concerned, we do parallel tracking of ECL. For our bank, I don't see too much of impact coming in. But the two key things we are looking for in the portfolio quality is getting the slippages down to below 3 to start with, and also to get the net NPA at 1% or lower in the very near future.
Well, that's pretty interesting because the net NPA for our viewers, just to give you a perspective, is lowest in 11 quarters, and very good, strong strength is coming across the segment. When we speak about the operational numbers, I checked the numbers in the you could say in the investor presentation. It was very difficult to take out the hard points to ask the management, but nevertheless, capital adequacy, that's around below the 16% mark. Just could you give us, our viewers, what does this ratio actually mean, and this number is dipping below it? Is it a mark of a concern? What is it actually?
Yeah, well, we have made reasonable profits in the first 3 quarters. That's not added to this particular number. So you would see a dip happening post-March, and assuming that we do make a profit for the full financial year, you would see the capital adequacy ratio going up again. From a tier 1 perspective, 13.5 is the red flag mark for us. We're far away from that. If the similar kind of trend continues, I don't think we would be requiring capital for meeting our 18 to 20% ambition of growth. But if the opportunity presents itself, we would be raising capital in a shorter time frame than that.
All right. One question is on co-lending. This has been the best outperformer, on the 9-month basis. I was just checking the numbers. It went up 117% on a year-on-year basis. Is it a small base, or what is it that, this number has caught my eye? What's the reason for it?
There are 2 things here. One is that philosophically, the bank believes in partnerships, in open architecture. We believe that by having affinities is a very important facet for the bank, and more importantly for the consumers. So we do co-lending with partners who are not in the same segment as us, not in the same location as us, or not in the same product as us. So segment, product, location differences there, which helps us reach out to customers who we otherwise wouldn't have reached out to.
Right.
Having said that, we are at about 16% is our co-lending book as a percentage of the total assets. I intend to bring it down to 15. In any given year, I don't think we'll be more than 15% of our book would be co-lending book.
Right. And Praveen, the last question is, what are the expectations for the budget, as a company or even as the banking industry would you like?
Look, I think a lot of good things are going for us. The GDP rate is growing at a good rate. Inflation is at a historical low. Labor market is strengthening. You having the reforms in terms of PLI and GST coming through. You have reasonably good monsoons. The rural market is good. Internal demand is strengthening. We're very happy with the way things are going, and I really wouldn't be happy. I wouldn't be disappointed with the status quo. And we're a small bank, and there's enough for us to serve the customer with the way things are currently going.